Welcome to the daily insights that matter. Now it's that time of the month again when we have a slew of economic data releases. Let's look at the fiscal deficit readings for this month. The fiscal deficit is the difference between the total expenditure and the revenue of the government. In other words, fiscal deficit is a shortfall in the government's income compared with its spendings. Now, India's fiscal deficit for the first 9 months of this fiscal through December stood at 9.93 lakh crore rupees, or at 59.8% of the annual estimates. Now, the fiscal deficit widened from 50.4% reported in the corresponding period of the last fiscal year. The fiscal deficit as a percentage of the GDP has been in a decreasing trend after it touched a peak of 9.2% in the financial year of 2021, as the pandemic had pushed the fiscal deficit beyond comfort levels. Now, having said that, we do believe that it needs to be brought down gradually. Now, with about 9 months of this fiscal year already completed, the fiscal deficit is at about a 60% level of the budget's target. As of right now, the centre's finances appear to be in good shape. The government's estimates of fiscal deficit for the entire fiscal year is at 6.4% of the GDP. Now, given the risks posed by global uncertainties, we do think that managing the government's finances and the expenditure side could become challenging as a result of the greater subsidy expenditures. However, the centre is likely to achieve its 6.4% GDP yearly target due to the higher nominal GDP, which serves as the denominator for the fiscal deficit ratio, and it is likely to be greater than the budget's 11.1 estimate. The output of India's 8 core sectors rose at a 3-month high of 7.4% in December 2022 against a growth of 4.1% in the same month last year. Now, the 8 core sectors is an index of the 8 most fundamental industrial sectors of the Indian economy. These sectors have great significant links with other industries and therefore strongly impact the Indian economy collectively. Now, the core sector number normally has larger ramifications for the index of industrial production, or the IIP, and also the GDP numbers. A surge in the output of almost all of the segments barring crude oil aided the higher growth in December. Now, the growth rate of 8 infrastructure sectors stood at 8% in the April to December period of this fiscal, as against the 12.6% growth seen during the same period in the last fiscal. Now, a rise in the core sector's growth in November and December at 5.4% and 7.4% respectively is indicative of an increase in the nation's industrial output. In contrast, the production of the 8 major sectors had decreased by 0.1% in the month of October. Rising domestic demand, easing inflation, and the government's emphasis on the infrastructural development contributed significantly to increasing the production of the core sectors. Going forward, along with all of these factors, the significant capex push by the government bodes well for the core sectors collectively. So what does all of this news mean for you? With 9 months of the fiscal year over, the fiscal deficit is at about 60% of the budget's target, and the government's finances seem to be well in order. This will therefore have an indirect positive impact on you. Now, the economic recovery in the country has been facing multiple headwinds, such as the looming global slowdown, monetary tightening across the globe, and the continued economic impact of the Russia-Ukraine crisis. However, the Indian economy has stayed resilient and is moving in the right direction, which also is evident from the recovery seen in the 8 core sector output. This will therefore have an indirect positive impact on you as well. While I say this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Did you like watching this video? Then download our app Informed Investor to watch more such informative and interesting videos.